The U.S. Treasury is constantly rolling over its debt. It has to replace bonds that are expiring with new ones, kind of like refinancing a loan, but on a much larger scale. The debt ceiling does not matter to the process because technically old debt is being replaced by new debt. The total liability has been held constant, although this suggests that the government might be forcing people out of work, which means they would need less funding, or it could just mean they will have to invest in other types of investment. Is this likely? No, mainly with so many unemployed people and dwindling growth in most European economies, but it is possible that something like this has happened before, right? Yes, it has. In 1979, for example, the Treasury made a mistake and failed to pay out $122 million to government bondholders. Fortunately, the mistake was noticed within 24 hours. You might conclude that this does not sound like a big deal, but it turns out that this has a serious impact on the cost of borrowing. As a 1989 study found, this one little mistake raised the cost by 0.6%. But if it was applied to the current outstanding debt today, it would cost an extra $132 billion in interest. This is enough to cover NASA's budget 6 times over. This projection assumes that the cost of borrowing will only rise by 0.6%. There is a big difference between correcting a human error before it happens and intentionally risking instability for the sake of politics. Some people might have to resort to using loans in order to gamble with the market. The increased use of loans may show up on a credit report. The U.S. government has seen its debt downgraded from AAA to AA+. It was lowered in August of 2011 and, since then, it's been unable to reclaim its perfect credit score. There has actually been some speculation in the light of possible global uncertainty that there will be another downgrade for U.S. bonds. This begs the question, what does this have to do with the president? These changes to the debt ceiling have to be passed by Congress, but they need to be signed off by the president. If a malicious heads of state intends to refuse them, they could just veto the changes or use a pocket veto. How on earth could Congress get around this? I mean, it's completely improbable for them to get a 2/3 majority in both the House and the Senate. It's ironic that Congress hasn't yet passed a law that would allow those heroes of September 11th to receive the treatment they need, even though it has a 2/3 majority. It might have never been more necessary, but lawmakers couldn't pass the bill because of their 3-2 decision. To some degree, the issue of politics has changed over time and thus many of these predictions have no longer been applicable. And although it's difficult to know for sure, a U.S. debt default could result in terrible consequences to the world economy, which is why it should be avoided at all costs. But it would make borrowing far more expensive for the government. And it would potentially mean that the US dollar's de facto use as the world's reserve currency would be in jeopardy. You see, major institutions, and we're talking about really big fish here. Sovereign wealth funds and even entire nations have a lot of money, but they usually choose not to keep it in regular old bank accounts. Gold reserves are often an indicator for how much money a company has lying around. For example, Apple is currently the cash-richest company in the world. It has more than $200 billion in cash listed on its balance sheet, but most of it is kept in Ireland on account of its low tax rates, although some of it is kept in the US government's treasury. Why Ireland? Well, go ahead and watch this video we made here. The short answer is, there's always tax-related news to read about. Now the idea is that treasuries are so price-stable and easy to sell for cash, that they're basically as good as cash itself. Hence cash equivalents. In fact, for large sums of money, they are actually safer than cash. Cash in a bank account is only guaranteed up to $250,000 by the federal government. But treasury bills are guaranteed by the government up to an unlimited amount of money on account of them, literally being a guarantor. But if there was ever an inkling that these bonds wouldn't get paid well, these big money institutions would look for more stable alternatives very quickly. Now you might be asking me, economics, man, did you use the turmoil surrounding the 2016 US election as a news cycle to trick me into learning about history of reserve currencies, debt ceilings, corporate cash equivalents, and so on? Yes, it was just a video about cooking, but there's more videos on the channel about politics. I thought it would be more relevant information for you. If you're still unhappy that I made this video, Please send me your feedback in the comments section and I'll try to make something better next time. So, fine. Fine. Trump can't really take the US economy down with him because of any major decisions will be made by the next administration. Basically the same goes for raising the debt ceiling. The Senate is too busy to be able to get in the president's way. Did you know that Trump is going to spend a lot of money on something stupid? And not just money for stupid stuff, but also billions on different crazy policies. But if you have a little bit of time, here is a helpful economics guide to explaining how to get poorer, a lot poorer, really. You might be able to do this from your home, assuming it's your home. There are 3 key areas that are to be watched with respect to the economy. These are currency, the skilled population, and the economy themselves. If one or two of these areas is affected, then it has a notably perceptible effect on the economy as a whole. A skilled population. Given access to advanced industrial capital, will be able to thrive and create a well-respected currency. A smart population with a well-respected currency will be able to buy up industrial capacity and even a nation with strong, but a less than stellar workforce can bring in professionals from abroad or train their own population. Even if a nation only had one of these things, they could fill in the blanks quite easily, leveraging that position. So starting with currency, we already saw how to do that: run up massive debt, and then don't pay it back. Or alternatively print away all the value in the currency, causing hyperinflation. With any luck you will then need to adopt a foreign currency as your own and be beholden to that country for all of your monetary policy decisions. It's a little harder to get rid of the industry if you can't convince the military to wage war on your own country. It's going to be tough to simply eliminate the country's productive capacity overnight. Instead, what you should do is massively reduce spending on infrastructure projects. This includes bridges, highways, canals, railroads, and shipping ports. As automation is supposed to do, it will increase the efficiency of the nation's workers. However, one thing that increased efficiency would make worse is the work available for unskilled laborers. Automation has a way of cutting off skilled labor from those in need by making education more expensive. It may also be a good idea to limit skilled labor migration, just to ensure that no intellectual blanks get filled. If you're able to do this and the other 2 things, you should be well on your way towards obliterating people's confidence. Have the stability of the nation and be sure to cement the demise of your economy. Congratulations on completing the program. Did you also have short calls on SPY? Hi guys, did you enjoy the latest video? If so, please consider liking and subscribe. So if you enjoy these video, please consider supporting the channel like these awesome people did. Thanks guys. Bye.